Hello, hello, everyone. Can you hear me okay? Yes? All right. 3:45 p.m. Thank you so much for still being here and joining us. The topic we're here to talk about is powering digital native markets with trusted infrastructure. And I promise to you, we are going to make it interesting and we are going to make it spicy. So the word trust really jumped out at me when I first read the title of this panel, because trust has been at the center of the discussion of the crypto movement over the last 2 decades. The idea of trustlessness was the vision around which we've all united and been building around. And yet, fast forward to today, we are operating trillions of dollars of volume, and most of that is still based on the traditional infrastructure that we have built post-1929 crash. And now these two worlds, they do collide, they do come together. Convergence does happen and it's inevitable, but where do we land on this spectrum of trust is what I really want to push our panelists to talk about today. And also, I'm a venture investor. I spend most of my time over the last 8 years investing in startups and investing in entrepreneurs like Charles, who just came off stage, building the trustless protocols. And are those the types of entrepreneurs we're going to back in the future, or the type of entrepreneur we need for the future has changed? That's what I'm personally interested in, and we're going to explore that topic. So I'd like to go, without further ado, panelists introduce themselves, and maybe talk a little bit about, do you think crypto will remain to be a sandbox that will operate as a parallel system to traditional institutions, or is it going to become the foundation of the new infrastructure? So Maxime, I would like to start with you.
Sure. Great to be here. Maxime, co-founder CEO of STS Digital. So from our perspective, I think in the last 2 years have been really interesting when you observe what was the story around digital asset and crypto native markets and where we are today. And so there's been a big shift where the disconnect between token prices and institutional adoption into digital and crypto native technologies are at 2 separate extremes. And I think it's really coming down to the technology itself has gotten a lot of validation. And we've gone through points where regulators are now accepting it, embracing it, and creating and working on regulation to be able to integrate it into the traditional financial system. But I think the question that really poses itself is, how does value accrue towards tokens itself out of the digital native world, from ecosystem projects, protocols that have been building those technologies and innovating over the last decade. And I think from that perspective, it's a really interesting divergence at this point. And it's, from our perspective, a big validation that we've gone to that the technology itself gets adopted into 24/7 markets and into the traditional financial infrastructure. But that leaves a question into, if the adoption takes place, what happens with the protocols that are not being adopted? And that leaves a big room for the winners to be integrated, and then from there, the token prices of other protocols that keep this divergence that we're seeing at the moment.
So you stand with the camp that crypto will remain to be its own separate sandbox, but certain winners from that will be integrated with the traditional finance.
I don't think I say that it's a sandbox by itself, but the more the institutions are coming in and integrating blockchain technology, the more the value will accrue towards the institutions that are coming in and using the technology, and away from the digital asset native protocol tokens.
Okay.
And I think that is something that has become very evident over the last 2 years, looking at token prices versus the institutional adoption that's taking place.
Paul.
Yes, hi, I'm Paul Frost-Smith. I'm the CEO of Komainu. We're a digital asset custodian primarily operating outside the US. It's an interesting topic. I mean, I think that overall, what we've seen is that, I mean, we only operate in the institutional space, so that's very important to make up front. So on the retail markets, we don't touch it at all. But I think, we sit as a custodian at the actual heart of trust in its most essential form for the market, because for any institution to come in, they have to be able to trust the gateway that they're essentially operating through. So that's where we've positioned our business. And I think, you talk about adoption, and I think, there's a lot of talk about institutions coming into the market, in size. We act for a lot of major hedge fund clients and family offices and these types of institutions, if you wish to call them that. But so far, the true institutions are still largely sitting on the sidelines, the huge asset managers. Having said that, they are now dipping their toes into the water. So last week, we announced a major deal for Aviva Investors. So that's a major insurance company, asset manager in the UK. That signals the fact that they are now actually starting to trust this infrastructure that's been built. Remembering, of course, that a lot of this infrastructure was built for the retail market, not really for the institutional market. So I think there is now a growing shift towards acceptance and trust of this market, but I think it's still in its infancy as far as the very large institutions are concerned.
Speaking of an institution that is not just dipping their toes in the water, but jumping in the water, Caroline.
Great. So I'm Caroline Weinberg. I'm the Chief Product and Innovation Officer at BNY. For those who don't know, BNY is a 242-year-old institution. And some may say, wow, that's super old. Like, how can you guys innovate or do anything interesting? But in fairness, we wouldn't still be around if we didn't constantly innovate and reimagine. So I would say it's a pretty cool place to work, and it's super interesting. And what's really amazing is that we do sit as the financial infrastructure of markets today. We are the largest custodian in the world. We are the sole settlement agent for the US government for treasuries. We clear 95% of the treasuries as they trade in the secondary market. We do trillions of payments every day. If you look at any one of our businesses, you're like, wow, that's remarkably large, at scale, and a trusted central player globally in the financial markets. So the question is, are we a sandbox user of digital assets, or are we adopting blockchain as that future infrastructure? And the answer is really that we use both. So we have a strong view that the markets are moving to always on. And that's not simply that you and I are making a Venmo payment to each other or whatever application we're using, or trading after hours on one of the platforms that we can talk about here, or the CME that has 24/7 some sessions. So the markets are actually moving. It's not just retail, but it's also institutional, and the collateral and the marketplaces that go with that are actually evolving significantly. So as the participant and the enabler of these markets, our job is to enable that 24/7, always-on market. Now, how do you do that? When we settle 25 trillion of treasuries every single day, are we going to whole hog transform the market and say, we're going to only use digital? Definitely not. At the same time, our scaled systems work really well. We just need to extend them to be longer hours, and we actually are tokenizing at the same time so that we can leverage the life cycle of the asset and all that we see across issuance to financing to custody and so on and so forth. So our view is that existing systems are critical. Tokenization and the blockchain is a critical element, and together we drive an always-on market.
David, so you sit in an interesting place on this panel where you are a crypto-native institution, but you are a centralized entity. So you're relying on certain parts of the blockchain, but you also have trust and control. How do you think about this question of sandbox versus integration into the financial ecosystem?
Yeah, sure. So a bunch of pieces here. First off, Dave, co-CEO at Payward. Payward is the parent company for Kraken that many of you are probably quite familiar with. But now we have many other brands beyond Kraken. So emphasizing Payward as the holdco for all these various different products and brands. So this is a fascinating topic for what it's worth for me, that one that I think about very frequently, because I got into crypto back in 2013. We called it Bitcoin at the time, not really crypto. And I went down the rabbit hole and all these types of things and was like, wow, this new decentralized technology, it is incredible. It's going to change the world. This is, the path we're going to go. And look, this is just so fundamentally different. Decentralized versus centralized. And never shall the two really meet, right? I mean, it's just going to be like, this one's going to grow here. This one's going to continue to decline. And, over some number of years, decades, we'll see this shift, right? And then a few years later, there was this big push for a lot of institutions to build. The phrase was, it's blockchain, not Bitcoin, and to build these permission ledgers. And that was around like started 2014, 2015 time period. And one thing that was true one thing that all those efforts had in common was they all failed. And so we kind of looked at it, and that further reinforced it. It said, like, okay, look, never shall these two meet, because look, they did all these. They kind of took the Bitcoin out of it, did this permission ledger thing, and it's like, look, it doesn't make any sense. So fast forward to today, and it turns out that premise was kind of wrong. And it turns out that there is quite a spectrum. There's nothing that is perfectly decentralized, nothing that is perfectly centralized in many ways. You could say there are some things that are perfectly centralized, but certainly nothing that's perfectly decentralized. And there's kind of a spectrum across the board. And furthermore, what we're seeing today, I mean, a number of different things. One, all of the traditional financial services companies are adding crypto into their offerings, ability to buy, sell, hold, so on and so forth. Mm-hmm. Crypto native companies are adding traditional financial services. We, are an equities broker, for example. Just traditional equities. And then the most interesting thing is now, I mean, after all these years, we're actually starting to see crypto tech power some of the TradFi stuff. And it's mostly, for the most part, the ones that are like successful at like any level of scale so far are, really the main one is stablecoins, right? I mean, that's, you have fiat currency, TradFi asset, right on crypto tech. This is, where we see the big adoption.
So that the stablecoins are an example or evidence to say that crypto is becoming the foundation of the financial system, not just
I mean, absolutely. I mean, this is the most significant, use case and point of adoption of these two things coming together.
Right.
Really. I mean, it significantly is. And I think the learnings from stablecoins are really meaningful, and how adoption grew there, who adopted first, what it took, what value they needed to bring to certain various different groups to get the flywheel going, which is the challenge, I think, with a lot of the different approaches in the industry is no one's really thinking about the flywheel and how to actually get over that adoption hump. And they're just thinking like, okay, this might be incrementally better, faster, cheaper, 5% cheaper, 5% faster, whatever. That doesn't drive adoption. You're not going to get anywhere with that. You need something that's actually, this is where you got to take a page out of the Silicon Valley entrepreneur book. You need something that's actually 2x better to get someone to shift away from what they're doing today to actually adopt something.
Build things people want. That's Silicon Valley kind of slogan, right? So Caroline, you said something interesting. I want to double click on that. You said that you guys do both. So there's certain technologies or perhaps layers of the stack that you use crypto innovations as a sandbox. Okay, let's see what happens there. And then certain things are actually being built into the foundation of the financial systems. In venture capital, we think about things in layers of the stack. And if you were to break down that layer of the stack of the financial system, what do you think needs to be completely rebuilt versus just integrated with the crypto rails?
So if you think about, so if we start from the beginning, talk about like assets. So you talked about stablecoin, but really it's about deposits, stablecoins, cash, treasuries, money market funds, composed or decomposed into a stablecoin. These things give some yield, this one doesn't, there are payments and so on and so forth. Although deposits don't always give yield. So you have like 4 different ways that you can make a payment. But that's the payment leg for something. But now you have these assets. So if anyone's buying something, they want to buy a security like an equity, they're going to buy like a bond, a treasury, whatever. And all of a sudden the assets turn into funds. So someone may have invested and created a portfolio, someone's buying that mutual fund, that ETF, and then you have a whole portfolio that's got a whole host of things. So at like the very basic level, you have like the cash leg, you have a whole bunch of assets, the assets become portfolios, the funds become whole portfolios, and then all of a sudden that's sort of the universe, if you will. So if you really want to transform the entire market, you need to start at the asset level. So first is cash, which I think David already talked about. The next piece is, okay, well, you've got all of these assets, so take fixed income oriented assets. These are over-the-counter assets where it's essentially a combination of terms and conditions and cash flows. So you can decompose any bond or any private credit or anything into terms and conditions and cash flows.
Right.
And the blockchain is actually pretty good at that. Now, when you start to change some elements of it, of accrual and tax and complexity that goes with it, you want to connect it to existing systems as well as the chains themselves. But ultimately, when you start to take existing assets, turn them into like blockchain ready or like tokenized assets themselves, they become really easy to compose then into funds. And all of a sudden, you have customization at the fund level and then customization at the whole portfolio level. So if you were to reimagine the entire stack, that's how one would think about it. But at the same time, it's not as simple as that, obviously, because you have the combination of existing assets and other native assets as well. So for us, we think about, from that sandbox perspective, how do you turn existing securities or existing over-the-counter investments or assets into the combination of these things, and let's figure out if we can improve the processing and the transferability and the, all of the pieces that go with over-the-counter market securities or publicly listed securities or everything else. But again, it starts with the asset level and then all the way up.
Right.
I think there's, just to that point, another layer to add onto it, which is one is moving assets on chain. And through that, what you enable is 24/7 movement and movement from A to B without friction that you have in the existing process. But beyond that, what it enables is the opportunity of turning trading of assets, and that's really traditional assets, into 24/7. And once you enable the 24/7, what's actually quite interesting, going back to your initial question, is that the existing platforms like Hyperliquid, with their success and the volume and the traction that they've had initially on traditional assets, has created a lot of pressure for the traditional system to question, okay, how do we upgrade to be able to compete with that 24/7 trading? And it creates this push-pull effect that really forces traditional finance to rethink how to upgrade, and it compresses the timeline of upgrading as they want to retain their market share and volumes. But then once you have the trading in 24/7, then you add those questions about, okay, you need to be able to margin 24/7. In the existing system, margining, if you trade on Friday evening, your margin call is going to arrive on Monday. That's just too long. And if you go into 24/7 trading, you need to automate margin. Then you need from there to understand how to transfer collateral from A to B. And so the more we move towards moving assets on chain, the more it's going to create those second order requirements, which is going to be 24/7 trading, 24/7 clearing, margining, and then transfer.
So let me kind of take us onto the opposite side of the spectrum for just a second, and you guys can take me back to the middle. But the opposite side of the spectrum would be, we have everything in place already. All the primitives have been built. To an extent, all the laws have been passed at this point for assets to be natively issued on chain, for us to price those assets on chain, for us to trade those assets on chain, for us to collateralize against those assets on chain, and then to unwind the positions on chain. What am I missing? Why can't we do all of this on chain today? Why do we need?
Well, the reality is we can. We
Why
can
not?
and we do, and it already exists. It doesn't exist in all geographies for what it's worth, at least not, just not under the purview of a regulator, right? But I mean, with our XStocks offering, these are tokenized equities that exist. Of course, it's not for every asset class. We talked about stablecoins being the first success point. I think the next asset class that'll meaningfully move on chain, you go look at the most liquid asset in the world, probably the US dollar. Maybe it's arguable, I don't know, but that's the first one that moved on chain, right? US dollar. Look to the next most adopted among individuals, which I think is an important thing, not just institutions, and it's probably U.S. equities, right? And so this is the next one that I think is meaningfully moving on chain. Our XStocks, ecosystem product offering is the market leader currently. And all those things that you described do exist. I mean, there are perp dexes that trade against XStocks. There are spot dexes that trade against XStocks. They trade against stable coins, lo and behold, and so those parts of the ecosystem work. And they, now it's, I usually quote over 50 different, venues, but that was a couple months ago, and we're adding several new centralized exchanges, decentralized exchanges, traditional brokers over a period. And so it's, I mean, we're growing.
So you're saying the future is already here?
Well, I mean, it's growing exponential now, but I mean, this is a massive space, right? I mean, so like even growing exponential from basically zero still is going to take quite a bit of time to, to move the industry. And certainly, like, it's not available in the U.S. today. So that's one not available to actually just go and trade on a broker today, and well, lo and behold, that's a regulatory step that's necessary, right? So you do have those pieces where, that exists. In Europe, it's different. We've actually accomplished the regulatory steps, and so it is available there, and they do trade.
Speaking of Europe, Paul, most of your clients that you interface with are institutions, and you have a pretty strong position about tokenizations that I would like to bring.
No, I just think we need to, ask why we're really doing it, right? So I think, tokenization for tokenization's sake is not a worthwhile exercise, and I don't think anyone would really disagree with that. The question is, how do we create liquidity in these markets, right? So the fundamental thing that we need is, the demand from people that actually want to participate in this, and I think there's, on one side of tokenization, you have the whole retail market. Let's say we're not involved in that, and David would be able to talk a lot more about that. But, are we just tokenizing things so major institutions can move things more quickly between themselves? Because, yes, there is, of course, the advantage of collateral mobility. So being able to move things fast 24/7, that's absolutely fine, and that's great, because if there's a sudden market move on a Saturday night, then you need to get your assets from one venue to another to cover margin, whatever. That's a real benefit of tokenization. But I think there is a risk that a large portion of the tokenization market ends up being used really as greater utility for assets between major institutions. So I think that's one of the areas we're heading into. And as I say, on the retail side, whether you want to own 1,000th of a Ferrari or something, that's fine if somebody wants to do it. But it's not the area we're interested in.
I mean, I think that's like what we've seen hasn't been successful so far, right? And I think that's the question to ask is like, why tokenize? Why tokenize?
Yeah.
Right? It already exists. Okay, you can do 24/7 without a token on a blockchain, right? I mean, you kind of have this challenge of like, moving collateral on weekends, and you get slowed down by, FedWire or whatever it is, but that, is a piece out there, and like, okay, stablecoins can get you over that hope. But you don't need to tokenize the equities to move the stuff on the weekend. You could just run CME on the weekend, run NASDAQ on the weekend, you get there, and then you got to figure out the fiat. Okay, so you got to think about where the adoption is coming from, right? And if we take a page out of the stablecoin book, who were the people that actually had an interest in holding stablecoins and then using them? The holding is actually a very important part of getting these, assets to become adopted.
Is it people who could not get access to U.S. dollars?
This is the answer. Is people that like literally, and this is where you get to like a 5x better. Like literally my alternative is maybe coming across a $100 paper bill because I live in Argentina or Vietnam or various different parts of Asia Pacific or whatever. And that's my alternative because it's very difficult for me to open a US dollar bank account. And so stablecoins was a huge use case for those individuals. And that was like a big driver of early stablecoin adoption. People wanted to buy those that, various different, businesses and companies found ways to kind of like extend that offering to those. And that was a huge, huge driver. By the way, We see the same thing with XStacks right now on the early people that are adopting this technology. What was the other big driver for stablecoins as far as adoption? It was effectively people, traders, trading across cryptocurrency exchanges where their alternative was to open a US dollar bank account and use SWIFT. Well, there's two problems with that. One is SWIFT sucks, right? I mean, we support it. I mean, it's literally double-digit % of transfers fucking fail. It's like, it's horrendous, the cost, the time, all those types of things. But there's even bigger problem. None of those traders could get access to SWIFT in the first place. So they literally had no other alternative whatsoever. And so that was like, so that's where you finding these things that are literally like 2x, 5x better than their alternative today.
Yeah.
That's like how to like, where you need to get the flywheel going and get something where we start seeing like meaningful adoption.
Yeah, I think if you go back to the use case point that Paul was raising, I think like you've identified some clear like unbankable types who would like love some elements of stablecoin. At the same time, from an institutional perspective, there's massive benefits to moving money faster, and the cutoff windows that exist today to fund inter-affiliate financial institutions is requiring significant capital around the world that actually can be released. So when you think about what Maxime was talking about with regards to collateral markets, so not simply the use case of inter-affiliate funding and reducing capital, but also, gosh, if only I could finance on the weekend my collateral. Like, wouldn't it be really nice if I didn't have 10-day VAR for my initial margin? Gosh, if I could actually post on a weekend, that's better. So there's a concept here that's real use cases, trillions of dollars of capital that is locked up because of inefficiencies in markets. And when I say inefficiencies, the market just closes. It's not like, you know, the traditional inefficiencies of like frictions that you talk about in other areas, but the market just closes or the cutoff window stops. So you literally can't wire the money. And in that, if you can actually either extend systems, you certainly don't need tokenization, but when you want to actually create the flywheel and interconnect the issuance to the settlement, to the intraday financing, to the like whatever it is, you need actually that interconnectivity, and that's the flywheel that tokenization enables. So that's why we have a strong belief that existing systems actually extended to be 24/7 or like as needed for all of these use cases, which are significant and massive, alongside tokenization that enables, again, this interconnectivity. Because if you can see the whole life cycle of an asset and drive that with more efficiency, well, why wouldn't you do that? So our view is that the institutionalization of like blockchain technology is really about accelerating that life cycle of the asset, connecting everything to always on, and enabling this massive release of capital to make the systems sounder and safer.
I totally agree. Like, look, the getting there is, of course, the challenge, but the fact that we have this open programmable network and now assets, you know, can, you know, exist and be interacted with via APIs and SDKs and so forth is a game changer. Also on the same database. I mean, assets in traditional financial services is always a different system and different database. You need the intermediaries to bring together, you know, the Fed system plus the equity system plus the, you know, futures, derivative system and so forth. Now that they all exist on the massive, I mean, it goes back, I mean, it's the same exact story in this instance as the internet. I don't know if everyone's seen that David Letterman, wasn't he interviewing like Bill Gates, and he's like, you know, we'll be able to, what's great about the internet? Oh, we'll be able to, you know, watch videos on your computer. And he like laughs. He's like, well, have you ever heard of a TV? He's like, well, but you could record and whatever. He's like, well, you ever heard of a VCR? And lo and behold, Bill Gates was right, but it made sense. It's like, look, if that's what you're talking about, but once it became open, and the initial use cases for YouTube had to be actually something meaningful, was individuals could actually interact with it, post their own videos, whatever it is. And now we have video basically running across TCP/IP substantially, and at some point it'll be in the entirety of it.
Right.
And so getting over that hump is big. And financial services kind of like didn't really have that internet, that movement to the internet in the same way until all these new technologies quite as substantially, because Well, it's a challenge because like a lot of parts of the network are owned by the governments, right? That's a challenge.
Well,
Then
so
there's regulatory.
I was afraid we're going to have too much time, but I'm afraid that we're not going to have enough time to go through all the questions that I want to go through. But I want to double click on the internet analogy, but I want to go to you, Maxime, and come back to where we started. And when you opened up, you talked about the idea of value creation and where value is going to accrue. So this is the central topic that we as venture capitalists spend most of our time. And there's a lot of theories that have permeated this space. Circa 2016, there was an idea of a protocol, fat protocol theory, all the value will accrue with protocols. Then we went to all the value will accrue to applications. Now all the value is going to accrue to institutions, and perhaps all the value will just accrue to the user, and nobody's actually going to win. So there's a few different trains of thought there. But if we think about the internet, you mentioned, well, we had newspapers, and newspapers got disrupted, right? And we got Facebooks and Googles, and we got a completely new set of companies that were born out of it. What's going to be the future here?
I mean, I think if you zoom out, the infrastructure of the existing financial system dates back, and the roots of it are from the 80s, the 90s, and then it has been iterated and improved since with electronic settlement and clearing. But the root of it has not really upgraded since, and it still works on a bilateral confirmation, T+1, T+2 settlements. And so if you look, and today, since we're talking about digital native infrastructure, and how to create it in a trusted environment, upgrading that from sort of analog or enhanced analog into digital itself in a way where it remains in a trusted environment where you can, with trust, sleep and know that your assets are safe, it really comes down into making the existing financial system more efficient and reducing the operating costs on a day-to-day basis for settling and transferring value from A to B, or transferring payments from A to B, or from buyer to seller. And if we can use the technology that has been built within crypto native ecosystem over the last decade and take what has worked and what has been battle tested and integrate it into the traditional system to make it more efficient, that will reduce the costs, it will drive up competition, and that will reduce the end user costs at the end of the day and improve the user experience to be able to transfer money faster from A to B, to be able to transfer collateral as well and assets from A to B with less friction. And in doing so, it should really come back to the end users and to the investors of the world that will be able to reduce their fees that they're paying towards processes that are nowadays outdated and can be improved.
Okay, so your position is that the incumbents are going to accrue value from this technology because they're going to become more efficient, they're going to cut their costs, and therefore they're going to become, better, more profitable, and then we should probably put more money into some of those incumbents. Is that correct?
I guess the question is really what you define as the incumbent, but I think what we can say with confidence after 10 years of building products in the digital native markets is that the benchmark for payments is a double-click Apple Pay, and that's what users are using and demanding today. Why? Because it's just simple, and it just works, and there's not that many more fees that you end up paying as a user. It's the merchant that ends up paying them. And so from a demand perspective, users are actually going for products that are easy to use and minimize the friction that they have in using them. From my perspective, and happy to hear if anyone else sees it differently, but I don't think that the USP that, as example, digital native markets with decentralization or self-sovereignty of your assets by holding your key has been a USP that has outweighed the simplicity that Apple Pay, as example, offers to end consumers.
Okay.
And therefore,
so I'm going to have to go to the next panelist because we have 3 minutes left and then we have a lightning round. But I'm going to actually narrow the question a little bit. So let's imagine there are 4 categories. Let's call it 5 categories. First one, decentralized protocols, DAOs, foundations, the likes of Aave, Compound, MakerDAOs, category 1. Second category, public blockchains, Ethereum, Solanas of the world. Third category, blockchain native companies, the likes of Kraken, incumbent institutions like BNY, or none of the above. Which category is going to be the winner and which category is going to be the loser? And you can't name your categories later.
Anyone?
Let's start.
Our ticker is BNY. I'm like, I know not to, but I think like the reason why I work at BNY is because sitting with the central positioning
You
of trust.
cannot take this your side. You have to pick one that's not
I think it's
yours.
great. And at the same time, we work a lot with all of the other players, actually. So in my mind, it's an entire ecosystem. And in like the Nash equilibrium, like actually, if everyone plays together, the whole ecosystem rises. So I actually think you need all of them to play. You can't have Aave without like a tri-party that works really well. Like we sit here and do tri-party all day long. Our clients are going to say like, who's liable if I'm using a decentralized system? So you need to apply control counts and actually the systems that work to go at scale with those. So the combination of centralized and decentralized is really actually quite remarkable. And I do think the whole market grows.
I think from an institutional point of view, DeFi is really going to struggle. I just don't think it's there yet. And I think
Sorry, say it again. DeFi is?
DeFi is going to struggle. So if you ask me to pick a loser over the next 2 or 3 years, it's probably DeFi. But I would go with most of the innovation coming from the crypto native side and being, the relevant parts of it being picked up by the incumbent institutions.
So the DeFi will invent things, but will actually not accrue value.
I think ultimately they won't accrue the value from, and the interesting parts will be picked up elsewhere.
Yeah. So that's wrong. No, DeFi is going to crush. But I would pick none of the above. Because you kind of said it earlier. Like ideally, it's the individual user, individual freedom as the big winner going forward. I think we had that with the internet. Yes, it created some like very big, super successful companies that are like massively successful. I get it. We'll probably end up with like a number of very successful companies in financial services. I think the ones that are very tech forward will be the most successful. But ideally, the biggest winner are individual users in a very global way, and in a very, very much global way when we think broadly across the world.
Okay, we're out of time, but I am going to ask one question, lightning round, yes or no, or one word answer, each panelist. So David, let's start with you. Yes or no, will 24/7 trading of US equities be live by the end of 2027?
Yes, it's live today.
Caroline?
Yes.
No, different question.
Oh.
Sorry. Does your 5-year plan depend on a blockchain you don't control?
I don't know what control means, but our 5-year plan definitely requires blockchain technology.
All right. One word, the durable moat in business, 5 years out, in this business, in crypto business. Balance sheet, license, client relationship, technology, or liquidity.
Technology.
Great. Yes or no? By 2030, there will be more trillion-dollar tokens than trillion-dollar companies. Yes or no?
No.
With that, thank you to our panelists and great discussion.